SpaceX just pulled off the largest IPO in history, and the tape is going completely parabolic. But beneath the sensational headlines, an acute mechanical supply and demand imbalance is dictating the immediate price action. This is a real-time market structure analysis of exactly what is happening under the hood of the SpaceX ticker. We're breaking down the order flow, the derivatives market, and the exact float mechanics driving this massive move.
This stock is moving like a momentum explosion. The central question for swing traders and institutional risk managers right now is this: does this price action represent real, sustained institutional demand, or is it an early IPO momentum distortion driven entirely by market plumbing? To understand the immediate risk to capital, we have to bypass the narrative and look strictly at the math.
The verified intraday high as of June 16th hit an incredible $225.64. Keep in mind, this offering was officially priced at $135 just a few days ago on June 12th. That is a violent, unprecedented acceleration in just 3 trading sessions, printing a near-vertical move on the charts. This magnitude of price expansion in such a compressed time frame forces us to look closely at the sheer scale of the capital that's currently trading hands.
At these elevated levels, the market capitalization of SpaceX has swelled to roughly $2.5 trillion. That overtakes mature mega-cap giants like Amazon. It's currently trading at an estimated 130 times price to sales, and it's doing so alongside deeply negative free cash flow as the company aggressively pours billions into its infrastructure. Fundamental valuation models are taking a back seat right now. This is purely a structural trade.
Section 1. Who is driving the move? Capital versus narrative. So, who exactly is the marginal buyer creating this relentless upward pressure? The answer reveals a massive divergence between public perception and actual capital deployment. Data from Autonos tracking over 50,000 public mentions shows a stark contrast. Financial media networks and X are in a state of absolute euphoria, registering 69% bullish sentiment. However, on retail trading forums, where actual discretionary capital is deployed, the mood is highly skeptical, with bearish sentiment actually rising to 23%. The mainstream narrative is currently masking a deep structural divide in how this specific trade is being positioned.
The mechanical flows tell the real story of the tape. Heavyweight institutions like BlackRock, with a reported $5 billion pre-IPO order, are hoarding allocations and locking up immediate supply. Passive funds are preparing for forced accumulation via index entry, meaning price-insensitive bids are incoming. Meanwhile, retail traders who received allocations are facing strict 30-day anti-flipping penalties from their brokerages. This means if they sell right now, they lose access to all future IPOs. The net result of these 3 forces? An artificially choked supply on the open market.
Section 2. IPO mechanics and supply starvation.
This brings us to the structural plumbing of the IPO itself. The underlying mechanics are mathematically forcing the stock higher right now, operating completely independent of the company's actual day-to-day business operations. To understand the velocity of this move, we have to define the free float. The free float is simply the percentage of a company's total shares that are not restricted and are actually available to be bought and sold by the public on the open market. In a mature stock, this is a large, liquid percentage, but in a newly minted IPO, this pool of shares is heavily restricted.
And the current data brilliantly illustrates the severity of this supply shock. A staggering 95.8% of total SpaceX shares are currently locked up. The tradable free float is hovering around just 4.2%. Think about the implications of that structural bottleneck for a second. That means all of the massive global demand, the retail excitement, and the aggressive institutional block buying are fighting over less than 5% of the company's total equity.
Furthermore, instead of utilizing a traditional 180-day lockup where all restricted shares become tradable on a single predictable day, SpaceX engineered a staggered lockup. This is a highly customized, complex schedule where insider shares are released in multiple, smaller tranches over a prolonged period of time. It's a specific structure designed and executed to keep near-term supply painfully tight.
The timeline from when actual, meaningful supply will finally hit the open market is precise and it's far out. The first real opening comes after the Q2 earnings report, projected around September 2nd of 2026, which unlocks 20% of eligible shares. Additionally, an extra 10% unlocks early only because the stock has successfully held 30% above that $135 IPO price. The major bulk expiry isn't scheduled until December 2026, and Elon Musk's personal 42% controlling stake is firmly locked behind a 366-day cliff, restricting those shares until June 2027.
Section 3. Mechanical buying events,
forced index buying, and front-running flows.
Compounding this historic float starvation is an impending, highly calculable forced demand shock. Astute swing traders are actively front-running a series of mechanical buying events that will relentlessly unfold over the coming weeks. The index fast-tracking schedule is entirely unprecedented for a company of this size. FTSE Russell inclusion hits the tape on June 26th. The MSCI Standard Index Fast Track follows closely on June 29th, and an estimated NASDAQ 100 entry is projected to occur around July 1st. Quantitative analysts project this sequence will mechanically trigger between $22 billion and $27 billion in forced passive buying. Now, it's crucial to understand that these benchmark ETFs are mechanically forced by their prospectuses to buy SPCX to match the index weighting, regardless of whether the stock is trading at 130 times sales. They are completely price-insensitive buyers.
Exacerbating this passive flow, options trading officially launched on June 16th. This immediately ignited a derivatives feedback loop mathematically known as a gamma squeeze. Here's how it works. Step 1. Retail and institutional traders aggressively buy out-of-the-money speculative call options. Step 2. The market makers who are forced to sell those calls are left holding short gamma exposure. Step 3. To neutralize and hedge their downside risk, those same market makers must continuously buy the underlying SPX stock as the price goes up. When you force this unprecedented, relentless hedging volume against a microscopic 4% float, the price mathematically accelerates vertically.
If you want structured bull versus bear analysis without hype, subscribe to Future Ready.
Section 4. Price Scenarios and Probability-Based Outcomes. Shifting to the forward-looking trading horizon, this extreme volatility requires risk managers to map out clear, probability-based outcomes for the immediate term. Based strictly on market structure and order flow, the swing trade parameters are well defined. The bull squeeze scenario targets the $220 to $260 zone. This is entirely driven by the unbroken front-running of the NASDAQ index inclusion, combined with sustained options gamma pressure. The base consolidation scenario sees the price settling between 190 and 220 as the massive passive inclusion flows are finally absorbed by the market. Conversely, the bear reversal scenario targets $150 or lower. This would be triggered by a sudden valuation reality check, institutional profit-taking, or the early front-running of the eventual supply unlocks.
Despite the technical momentum, we have to inject a fundamental reality check into this equation. Morningstar's baseline valuation model, which calculates discounted cash flows, sets a fair value estimate for SpaceX at strictly $63 per share. That massive divergence implies that the remaining premium, bridging the gap all the way up to today's $215 plus reality, is entirely an option value assigned to future unrealized moonshot projects and near-term market plumbing.
Section 5. Imminent risks and structural dangers. The momentum phase we're witnessing right now is undeniably powerful, but there are severe structural dangers on the immediate horizon that threaten to break the current trajectory. The September 2nd earnings report is the most critical impending risk event. It serves as the first public fundamental test of actual Starlink and XAI revenue growth. 130 times price-to-sales ratio leaves absolutely zero margin for error. Any execution miss or lowered forward guidance will be punished aggressively by institutional capital. Furthermore, SpaceX actively holds 18,712 Bitcoin on its corporate balance sheet. This creates an unusual crypto market beta correlation that equity traders must now actively track. And finally, shifting geopolitical macro headwinds, where a sudden spike in treasury yields could rapidly alter the broader market's risk appetite for ultra-high beta momentum names like this one.
The institutional viewpoint on this specific setup is highly clinical and totally devoid of emotion. Take this quote from Alexander Schneider, lead analyst at Adanos Data. The bull case is real, but this has the makings of a classic retail trap. The ones who get hurt won't be the institutions with an allocation. They'll be whoever buys the early euphoria.
So what's the ultimate takeaway? The mechanical reality of this stock right now is that the immediate window to hold is tied directly to the restricted float and the forced price-insensitive index buying schedule. However, as we move inevitably closer to that September structural shift, the supply dynamic will fundamentally invert. Once that initial lockup breaks and fresh shares flood the tape, the market will have to decide, will the actual verified business fundamentals truly support a $2.5 trillion price tag? The answer to that specific question is exactly what will dictate the next major directional move.